Hi, I'm Paul Merriman, and I started the Merriman Financial Education Foundation just a little over, I guess, 11 years now. And the focus of all of our work is about helping you, as the do-it-yourself investor, do it better. We have on our website over 700 podcasts and videos and articles, all designed to try to help you understand this process. Now, there's a challenge in this process. There's a challenge because there are literally hundreds of thousands of people, if not millions of people, who want you to do something else. With, of course, the sales pitch being that if you follow them, you'll do better. Now, I must remind you that in life, when people are trying to convince us of something, whether it's a sales pitch or it's educational, whatever bias we come with, the intent is to try to help you believe what we believe. And I've always viewed this as one of the very difficult times in life because there is the courtship, and the courtship is the period where we tell people how great it's going to be. On the other hand, following the courtship then is the honeymoon. There's what actually happens after you've been courted. But then there is the reality. And the reality very often in life does not look like the sales pitch or what we were taught. It's like we learned a whole new history when we became 50 and above compared to the history we learned when we were 12. So our job, as we see it, and it's not just my work, it's the work of Chris Pedersen and Daryl Balls, and it's the work of all the people that I call the truth tellers who are trying to share information with you that they think and I think is trustworthy. Now, by the way, that's trustworthy about the unknown, and we can't know. So there's only so trustworthy it can be. But I do believe this, that if somebody who is really looking for a reasonable and a strategy that feels comfortable, that you need to know the whole picture. You need to know what it's like in the good times. You need to know what it's like in the bad times. Because we need to take you as best we can to the reality of investing. And this particular series, and this is the first of a series of videos that will go along with a series of articles, that will go along with a series of podcasts. And I wish they were all ready to go all at one time. It's going to take us several months to finish this series. And at the end of that series, I believe you will know about 12 of the most important aspects of investing. And I start with the one that I consider to be the easiest of all, the most obvious of all, that is likely to pay you a huge premium over a lifetime of investing. And so in this first video, and we've already done the podcast and we've already done the article and the tables are up, I'm going to walk through with you. And I can tell you, I wish I could sit down with you one at a time. Unfortunately, as I'm 80 years old now, I don't have time to do it. I've got to do it this way. A whole bunch of people, but I want you to think of it like I'm right there trying to walk you through these important pieces of information. And let me show you the first one here. And I want to see if I can get my pen working, if I might. Hang on here. Yep, I got it. So this is going to be my pointer, and boy, are you going to see a lot of important numbers with this pointer. But I first want to take on this topic of stocks versus bonds. And the reason that's such a big deal, I mean, literally, it is more important than the saving versus spending or saving early versus waiting till later. Whenever you get aboard, however you start saving, if in fact you choose equities or stocks over fixed income or bonds, I want you to get an idea of how big a decision that is. Because I truly think for many of you, particularly young investors, it is a multi-million dollar decision. And I think you'll see it easily. The problem is, can you get over the emotional hurdles that come with taking the greater risk of investing in stocks than bonds? So let me start with a table that is focused purely on bonds. Bonds are simply a loan, an IOU. I loan money to a corporation, I loan money to the government, and they promise to pay me back. In some cases, in terms of what we call short-term bonds, bonds that may mature every month. You loan them money, they pay you back 30 days later. Very short term. I mean, as close to no risk as you could possibly come. First of all, it's a government guarantee. And secondly, they promise they're going to repay you in 30 days. What could go wrong? On the other hand, and by the way, I'm going to move forward so you can see these numbers more easily if you're on a cell phone by chance. So we talked about the short-term government bond. So there's virtually no risk and there's virtually no return. Now, it doesn't look like that because here you can see over the last 96 years, $100 grew to be worth over $2,000. And that's because the compound rate of return, money growing on money, leaving all the money there to grow and grow and grow, it grew at 3.3% a year. Now, what happened to that 3%? Well, a lot of it was lost to inflation. In other words, you lost the buying power. You were not doing well enough to keep up in many cases with even inflation. And then on top of that, potentially taxes. So when I say it's a no-win long-term proposition, I'm only saying that as safe as it may be and feel, that the insecurity comes with what it looks like over a long period of time. Now, if you go to loans or the IOU that's a longer term, like I want to borrow for 5 years, well, now interest rates can move up and down, and when they do, the underlying bond value moves down and up. So what do we know? If you went to a little riskier bond, still government guaranteed, instead of growing to 2,000 plus, it's 9,500. And the compound rate of return was 4.9%. And by the way, I want you to notice that with the very short-term instrument, the best one-year return was up 14.7, and the worst year was a little teeny tiny loss. On the other hand, when you move to the longer maturities, notice the best year was up 29.1 and the worst year was a loss of 9.4. And that was just a couple of years ago. Something most people were not expecting because they hadn't seen it before during the last set of 96 years. When you looked at a 94-year period, you didn't see this, but now it's there because it just happened. But still, look at the long term. You made more than 4 times more. And by the time you go out to the very long-term government bonds, they have a lot of volatility on a short-term basis. You can see the worst year was a loss of 26.1%. That happened a couple of years ago. And the best year was up 40. But the compound rate of return was 5.2. So on a short-term basis, if you If you needed money to pay a bill in 30 days, you wouldn't want to put that money in the stock market or in a year. Or if you were saving for the down payment on a house in a year, you would want to keep it in something very short term. And when the US government says, I promise, so far they've made that payment. They've paid their debts, sometimes not so easily, but they have paid them. But I want you to see what happens when we go out 15 years, because our life is not about 1 year at a time. Really, it's about some pretty big chunks of time. I know, for example, somebody who might put money in the stock market for their Roth IRA when they're in their 20s, they may leave it alone and not touch it for 40 years. But they're going to judge it along the way. And I want you to get an expectation of what that judgment might, the outcome might look like. So here's what I see, that over 15-year periods, and there were 82 of them, the best compound rate of return over 15 years was 8.3%, and the worst was a gain of 0.2% a year. Now, I can tell you, you're thinking, whoa, I'd like to get 8.3%. But during that best 15-year, inflation was almost as much as it made, because it was during a period of very high inflation when these kinds of short-term instruments pay their highest return. But still, after inflation, not much left over. But you can notice that as you extended from short-term to intermediate to long-term, that the best compound rate of return was 8.3, 11.3, and 13.5. And yes, they're all bonds, or they're all government paper or securities, but they're very different in their characteristic. And I think this is important for you to see this. And the reason I think it's important to see this is because a lot of people forget, when they get into the equities, into the stock market, that they're going to face the same thing. There are very different kinds of stocks that have historically had different levels of risk and different levels of return. They don't all look alike, just like the bonds don't all look alike. But for many people, and this is a frightening number for a lot of young people who are counting on, by the way, they're not sure about Social Security. They're not sure about getting a pension. They're not sure whether their parents are going to have much left over for them, by the way, by the time they go through whatever assisted living they might need in the latter part of their life. They don't know. And yet, when they make investments, only about 30% of them want to have anything to do with stocks, but they love bonds. And I just want to say that while they can be loved over the short term, that when you compare them to the long-term risk, which you're going to see in a minute for stocks, to me, there's no comparison which is right. But 70% of young people are not willing to take the risk of the stock market. We'll talk a little bit about why that might be. But now I want to take you out to 40 years. Imagine somebody had $100 and they invested it for 40 years. And that range of return was anywhere from an average of $565, about 5 times, to almost 1,000, to about the same. 979, 964. Interesting, by the way, here. This is a very interesting number. Notice over the long-term government bonds, they're more risky, they're more volatile, but they make about the same return over the long term as the intermediate term bonds. So one of the reasons when we encourage people to own bonds, and we'll talk about that in a future segment, under our boot camp, there is a time to own bonds. I'm 80, I'm half in bonds, half in stocks. I don't want to take a lot of risk. I want some, but I don't want a lot. But many of you are in the accumulation stage where you do want to take advantage of higher rates of return. And the question will come, will they have come at higher risk? Well, certainly in the short term, they have. And by the way, notice while the average compound rate of return for short-term government bonds, the T-bills actually was 4.4. The range was from 1.6 to 6.1. When you looked at the intermediate, it's from 2.8 to 8.1. When you look at the long term, it's 2.3 to 9.7. None of these have been home runs because those higher returns have almost, well, they've always come during periods of high inflation. So then, when we leave the world of fixed income and IOUs and loans and guarantees, and those guarantees can come from corporations, but the corporations don't always pay their debts. Just to know that, that's the reason corporate bonds have historically made more than government bonds, because they are more risky. Sometimes they cannot meet their responsibility and they go bankrupt. But at the other end of the spectrum is the stock, the ownership of a share of a company. That company doesn't promise you anything. What they do is they tell you they will come to work, they will do their job, they will try to make the company profitable, they will try to grow the company, they will try to make the company a good, socially responsible, some will say that. We're going to do for the good of our society. Other people don't care about so much about the good of society. They care about maximizing profits, and that's it. But those corporations are not guaranteeing you anything. They'll do their best. And by the way, many of them have had amazing histories of success. But we have to know that about half of the companies over a long period of time do not survive. They either go bankrupt or they get merged away into another company. And something very interesting about these stocks. Dr. Bessembinder out of the University of Arizona did a study along with some other academics, and they looked at the returns of all the public companies since 1928 or 27. And they looked at the returns. And as they reported, about half of the companies didn't make it. But while they didn't make it, the other companies were doing better and making up for the ones that didn't make it, so that the return for the group was very fine. But more interestingly, they found that about 4 out of every 100 companies, 4%, were driving most of the return of the market. The problem is nobody knew what those companies were going to be ahead of time. And if they had, they would have simply invested in those 4 out of 100. And what the academics have told us, and a lot of people don't want to believe this, that if you own all companies, you are likely to get a better rate of return than if you try to cherry pick what you think are going to be the great companies for the future. That when you own them all, you are guaranteed to own the 4%. And by the way, then you're also in essence guaranteed to own the losers. But what I'm about to share with you are the returns of, in essence, kind of the whole. Now, just like there's short-term bonds and intermediate and long, and there's corporate and there's high grade and high yield, I mean, there's US, there's international, there are all sorts of bonds. And there are all sorts of stocks, of equities. And we call those asset classes. And so we like to look at the returns of those asset classes as a group. And in this study that I'm going to share with you, we have the ability, because of the academic research, to be able to look at the returns of four very major important groups of equity asset classes. And so I'm going to go through a review of those returns, both on a short-term and long-term basis. Now, when I say short-term, I can tell you that if you put $100 into the LCB, large cap blend, that is, in essence, the S&P 500, 500 large companies. Why do they call it a blend? Blend of what? A blend of growth companies, of very successful companies, popular companies, companies that have an amazing future. And then they also own what we would call value companies. These are not necessarily exciting companies, but they manufacture products we use every day. I mean, think of companies like Johnson and Johnson. I mean, we use a lot of their products. They're not known as being high-powered growth companies. They're more of a value-oriented company. But they're both in the S&P 500. And theoretically, if you want to think about what kinds of companies are in that particular group, that asset class, they're all very large. Some, by the way, are worth $1 trillion. How do they become worth $1 trillion? How do you know they're worth $1 trillion? Excuse me, you multiply the price of a share of stock that they have times the number of shares they have. That is the value that is being put on that company. So that if somebody had $1 trillion, they could go theoretically buy all the stock. Well, it isn't quite that easy, because a lot of people, millions of people, are going to own that stock. And many of them have no interest in selling. They want to hold it for the long term. The beauty is about these companies, if you decide today you want to get out of it, you don't have to worry about things you have to want to, when you want to sell a house, for example, all the stuff you have to do. Now, when you got a share of a company, you just sell it on the open market. It's very simple, very simple. And by the way, almost no commission anymore to buy and sell the individual shares. But in looking for the reality, it is my belief that the best information I could bring to you, and I didn't create any of this. There is not one thing that I teach. I mean, I am a teacher. I am not an academic studying the history of investing. I am a teacher. And as your teacher, what I have found from the people I trust is the following. Here, over the last 96 years, based on one-year returns over the period 1928 to 2023, when I look at this group of stocks, big companies, successful companies, maybe some struggling companies, but big companies, the compound rate of return has been 10% a year. And $100 grew to $950,000. Now, that's pretty amazing. By the way, with a 10% compound rate of return, you double your money about every 7 years. Unfortunately, as you probably know, the market doesn't go up 10% a year for short periods of time. As a matter of fact, from 2000 to 2009, it lost about 1% a year, okay? And that was after for 25 years, it had made 17.2% a year. So there is nobody who can tell you, when am I going to get this 10%? But we do know that if you looked at holding it for the entire period, that you would have had a wild ride. You would have had a year you were down 43%. Now, in between years, there were many times it was down 50%, even more than 43. But if we look at the calendar years, that's the worst calendar year, and the best was a gain of 54. And for those who care, the volatility rating, the standard deviation was 19.8. Now, what you'll see is that when that number is higher, there's typically higher volatility and more risk. But compared to the bonds, I mean, think about the bonds. Down 43? No. Up 54? No. Now, what's interesting, and this is what the academics teach us, and you can choose to believe their sales pitch, or you can choose to believe the sales pitch from Wall Street. But what we know is if you look at, instead of combination of growth and value, if you took out the good companies and you were just left with the less exciting companies, it turns out, because as a group, they are more risky. Those companies compounded not at 10%, but at 11. And the $100 would have grown to $2.3 million instead of a 950,000. But the standard deviation, the volatility was higher. And in fact, you had one year that was up 92.5, and you had a year that was down 61.1. We are not interested in what happens in a year when it comes to our long-term investments. You don't worry about the price of your house 1 year at a time. Well, you might. As a matter of fact, we don't want our house to go up in value because we have to pay more taxes. But just like houses, don't go up at some set rate, there are bad times and there are good times. And what they tell us is over a long period of time, housing is about a 5% compound rate of return. Not so dissimilar, by the way, to those bonds, which, by the way, were kind of the same return as inflation. So the value of houses have tended to go up at what is typically a small premium over inflation. Notice that the volatility is higher. The worst case year was higher. The return was higher. What you had at the end of that period of time. Now, you see, none of you are thinking 96 years, I'm going to guess. But when my wife and I, and by the way, I will have one of these boot camp pieces is going to be about what we can do for our kids and our grandkids. I hope you join me on that. But we gave some money to our new granddaughter about 1.5 years ago. And that money could, in fact, be all equities, all of her life. And she could live to be over 100. So to her, these are real numbers potentially. Okay. Oh, and I should say something here that's important. Going back to 1928 means, hey, this includes the Depression. This includes world wars or wars. This includes all sorts of huge inflation periods and I mean, good and bad times, economics and politically. I mean, there's just so many forces, good and bad things that happened. But this is what came out the other end. At that end. Oh, by the way, if you go to smaller companies and instead of these bigger companies, on average, are going to be probably around 100 billion or more. These companies are more like $3 to $6 billion. Smaller companies, they have made more money, 11.9. That 11.9 compound rate of return took the $100 to almost $5 million. And you had a year it was up 111 and a year it was down 48. And it's a combination of little companies that are blended of growth and value, just like the large companies. So, can it get better? Well, according to the academics, it can get better. And according to that history of returns, look at small cap value. Get rid of the hotshot small companies and just own those companies that are, I'm going to call them out of favor. People aren't willing to pay much for their earnings. But the premium for having taken that risk, and the academics ask me to tell you, I mean, this is something they ask that people understand, is they would never recommend these companies one at a time, but only as a group, so that over a period of time, you're likely to get the premium. Because what they tell us from their studies, if you look at any 5-year period and you look at the companies that were out of favor 5 years ago, and you looked at 100 of them, 5 years from now, 50 of them are still going to be dogs. It's the other 50% that have made the big premium what it is. And they have no way to know which of those companies are going to come out the winners. This is one of the reasons, and one of the presentations that I'll make during boot camp is I'll try to convince you to own, in essence, all of the companies within these asset classes. And now the $100 grows to almost 15 million. Now there are no taxes here, there's no management fees here, but today the management fees for these kinds of groups of stocks are 1/10 of 1% a year. Some a little more, some less, some free, actually. So now that's 1 year at a time. But because we know that we don't want people to own these based on performance for 1 year, we do want to see what it looks like when we go out 15 years. And we've got 82 of those 15-year periods. And what we see is that the compound rate of return for large cap blend on average for all of the 15-year periods was 10.7%. Now, wait a minute. What happened? Why was the return 10% before? Why would the return go up to 10.7? That's a big deal. That produces a whole bunch more money over a long period of time. But here's why. When we start looking at shorter periods of time, that period from 1929, for example, to 1932, it was catastrophic for a lot of people. And once you get by that 15-year period, because we're looking at 15-year periods, once you get by that 15-year period, you didn't ever have to face that same kind of huge decline. Now, you faced a lot of decline, certainly. But when you got rid of that 15-year period and you get beyond it, there's a whole bunch more, the impact of that one period has less on the total number there. So it was a 10.7, but here's the interesting thing. You might wish that you had a little bit better worst case scenario, but I want you to look. The best 15-year period for the S&P 500 was a compound rate of return of 18.9. The worst was 0.6%. So after you got out there 15 years, you always made something. Not much, but something. And you're going to see it even gets better when you go out longer periods of time. You'll notice with the large cap value that the compound rate of return instead of 11 is 12.7. Whoa. And the best 15-year, 21.7. The worst was actually a 0.6% a year loss over 15 years. That's a substantial loss. And when you get to the small cap, the more risky small cap companies, the average was 13.4 and the best was 23.2 and the worst was a gain of 1.6. And then finally, small cap value, the best was 26.5. What a 5-year period that was. I mean, think about how you felt about investing if that happened to be the first 5 years as an investor. You would think, as my wife thought, when after a couple of golf lessons, the instructor took us out on a couple of holes over in Lanai in Hawaii. And on the second hole, she parted at her second hole. And she had to go over a ravine to get there, as I, of course, was able to put 3 or 4 balls probably down the ravine. She thought playing golf was really easy. She found out otherwise later on. But it's the same thing when you have the first 5 years be runaway returns like that. Your commitment to the long term is much better than if for the first, 15 years, if for the first 15 years, it's up 1.6% a year. Those early years have a huge impact on people's belief and trust for the future and willingness to take the risk and kind of ride the wild waves of volatility that investing tends to produce. Now it even gets a little better, 26.5 for small cap value, for the best 15, a minus 1.9, so the worst of the 4. Notice the compound rate of return was 15.5. I do not believe that you are going to get a 15.5% compound rate of return. Now, I have specifically ignored the stuff over here to the right, but I'm about to start paying attention to them in just a minute. Because I don't care what, if you're 10 years away from retirement, you likely, and you're going to have 30 years in retirement, a lot of people do, you're going to have 40 years of something. Whether you have all your money in bonds or all your money in stocks or some combination, most people have some combination when they're older. And for some people, they're going to, who's starting at age 25 to invest, they could be 40 years in equities. Maybe not all equities all the time, but certainly the first 30 years, they could be all equities. Now, let's look at the average 40-year return. There are 57 40-year periods between 1928 and 2023. The compound rate of return for the S&P 500, 11%. For large cap value, 13.4. So these are two indexes or asset classes that are large companies. One is a blend of growth and value. The other is all value. And what we see is that the best 40-year period for the S&P 500 was 12.5% compound rate of return, and the worst was 8.9. So this is why when people in the industry say that bonds are safer for the short term, but stocks are safer for the long term, to the extent that we really need to build and make money with our money, and remembering that what we own to do that are some of the greatest businesses ever in the world, along with Enron, along with Washington Mutual, along with Eastern Airlines. I don't want to pretend that there aren't dogs and people that will hurt you, stocks, I should say. But here's what we know. That yes, the range 12.5 to 8.9, with large cap value 15.6 to 8.8, with small cap blend 16.7 to 10.6, and with small cap value 19, and 11.6. Boy, those are great returns. And here's the problem. You can't buy them. You can't have them. You can't count on them because nobody knows. I think about where the world was 40 years ago and what we've been through and the new products that have been developed. And as the new products were developed, the people it put out of business at the same time as it became viable. A time when the automobile companies were, well, I mean, as the old saying, as goes GM, so goes the country. Well, fortunately, the country didn't go bankrupt, but GM did. Sears Roebuck, when I came into the industry in the mid-60s, Sears Roebuck was considered to be the company you could go to work, you could be a janitor at Sears Roebuck and expect, because you would get shares of stock over the years, to retire a millionaire. No, it didn't work out that way. Now, had you invested in the S&P 500, it would have worked out that way. I mean, that's the interesting thing, is that the safer way, the more diversified way, has paid the premium with virtually no risk of being deep sixed with losses because you put all your money in Enron. And the problem is, remember I talked about the problem with people selling, and then the difference between the courtship and the honeymoon in reality. Well, the courtship at Enron, this is true. The people in the company, the officers, were telling the employees, yes, they should put all of their 401k into Enron stock. That was the courtship. And at one point, the honeymoon was wonderful until, in fact, the honeymoon was so good that it made it very obvious. You didn't even have to tell them to buy it anymore because they'd been buying it and they'd been making money. But the reality came. The reality was people got wiped out because they were oversold, because they didn't know to ask the right questions about risk. And these numbers that you see are the lowest risk way that I know for you to get a good return. Now, I also know that at the beginning of this long period of time, nobody knew the idea of a small cap company. They didn't know what a small cap value company was. Those kinds of understandings didn't come along until basically the 90s. That's the 1990s. And I might mention in 1924, investors did not believe in putting money into the stock market. They thought that was absolutely nothing more than a speculation, and the good place to put money was in bonds. That's what they believed. And then, of course, the Depression came, and a lot of people continued to believe that because the Depression taught them an interesting lesson, that you lose money in the stock market. And my lesson is, I guarantee if you invest in the stock market, you will lose money along the way, guaranteed. But if you diversify and you're careful, if you want to be conservative, just use the S&P 500. There is nothing wrong with the S&P 500. I would be trying to talk young people into expanding. I mean, it's like, it's okay if you got more money than you need to put all your money in short-term bonds. And it's not evil. It's not a con job. It's just a very low risk thing to do. And I would be trying to encourage, and you'll see some of this as we go along, to take some of that money out of bonds and put some of that money in equities. You're going to see what happens when you do that. And even if you don't have the the risk tolerance for a lot of stocks, even 10 or 20 or 30% can be a game changer. You'll see that if you stick around. So I'm not trying to say that small cap value is going to make 16.1% in the average 40-year period. I actually believe that probably for the S&P 500, 9 to 10 is legitimate. I believe large cap value is 10 to 11. I believe small cap blend is 11 to 12. And I believe small cap value is 12 and above. But it may take more than a few years for that to happen. But now, very briefly, I want to take you into the right side of this table. Because on the right side of this table, we have the implications of combining these four equity asset classes. Now, I am going to dig much deeper into this kind of analysis when we go into later, when we go into the ultimate buy and hold strategy and into the sound investing portfolios. I'm going to show you all sorts of information about risk and return of combining these and even some other equity asset classes. But just at the very basic level, I want you to notice that whether you took all four of these equity asset classes and you put 25% in each, notice the average compound rate of return was 13.7. Now remember, value did better than growth historically over long periods of time. But I want you to notice if you got rid of the small blend and you got rid of the S&P 500, the large cap blend, and only had a portfolio of those two asset classes, the compound rate of return average was 14.9. Again, I'm not dangling that number, suggesting that's what it's going to be. I'm only saying that I believe if you combine these asset classes, you can have more diversification. And you're going to see years when the S&P 500 is a dog and these other asset classes are doing just fine. And then you'll see times that the S&P 500 is blowing them away. And so this is how the market works. And nobody knows when all those changes are coming. Finally, a strategy that I just think is a wonderful strategy, because the two fund strategy with the S&P 500 and the small cap value, so that you only have two funds you got to worry about for the rest of your life in the equities part of your portfolio. The two being the S&P 500 and small cap value. It gives you value large. It gives you value small. It gives you value small companies, and it gives you large companies. And the compound rate of return is virtually the same as the four fund strategy. So the reason for this presentation is that I want you to believe long term that it's okay to take the risk of equities. But if you are going to focus on the short term, it is going to be very, very uncomfortable because it's going to scare you. You're going to feel when the market is going down, as it did, for example, for the S&P 500, from 2000 through 2009, it lost about 1% a year for 10 years. In fact, it lost more over that 10 years than it did from 1929 to 1938. And twice during that 10 years, it lost over 50% of its value. And the other asset classes, chugging right along. But prior to that, The S&P 500 was just wiping them out and performing brilliantly to where you wish I had all my money in the S&P 500, for crying out loud. It's so easy. They're companies whose names I know, and I don't know the names of the little companies. I would have felt so much more comfortable. But the bottom line is, in terms of what we're trying to provide, is not information on how to have fun as an investor. My wife and I do not have one penny invested for fun. We are focused on trying to do well with our investments because we have people who would like, who we know, charities and children who would like to benefit for our patience and our good decisions. So we're willing to take some risk, but we don't do it for fun. We find the fun elsewhere in our life where we sense we have maybe more to do with the outcome. The thing that investors need to understand is what you believe has very little to do with what the market does. I know about what I'm thinking, how I may interpret what's going on today, politically, economically, on a worldwide basis. The things I look at, there's always list A, the good news, there's always list B, the bad news. I got my good list, I got my bad list. I know how I feel. The world does not care about how I feel. And that's confusing to a lot of people because we like to figure things out and come to conclusions about what's going to happen because we figured it out. Well, this approach to investing that I'm going to show you over the coming weeks is not about figuring out anything except what asset classes have a history of paying a premium for taking the risk. How bad do they perform when they're out of sync with my expectations on the downside? And yet my expectations are there will be downsides. And I think I understand what those are like. I'm going to take you much deeper into understanding the downside as we move forward, because you're going to know not only what the worst year was, you're going to know the worst 12 months in a row. You're going to know the worst 6 months, the worst 3 months. You're going to know about the worst 3 years. You're going to know about the worst 5 years. You're going to want to know about the worst decline, regardless of time. It's called a drawdown from the peak to the bottom before it goes back up. You're going to understand as much about how this investment process works as any professional investment advisor. They can't know any more than you're about to know from this series. And by the way, this is not that I'm great. It's just that it is the fact that there's only so much you can know, and there are just a handful of things that we know historically drive your return. And a lot of it is if you have the patience to let it happen. And what we want is to give you the information that when the bad things happen, so we all like the good stuff, that we have no problem dealing with the good times. It is the bad times that we have to deal with. And you said, I want to be a do-it-yourself investor. I don't want to pay somebody 1% to take care of this. I want to keep that 1% in my family. Great. Now let's just make sure that you understand what the people who get that 1% need to know to get it for you. Because that's our goal, is to show you how to get it. Now, we're going to add this recording, this video, to our page about stocks versus bonds. And right now we have an article there, and we have these tables there, and we add the video. And then as I go through these different topics like fine-tuning your asset allocation, how much in stocks and how much in bonds, and how to build these portfolios and how to take money out in retirement and how to put money in. Every time we're going to have an article, a podcast, and a video. So you can explore it 3 ways. And of course, the tables of numbers. But then you have questions. And so what we'd like to do as we move forward is on each of these pages, we're going to have a Q&A section. And you're going to email either, when it's my stuff, paul@paulmerriman.com. And you can email Chris on his stuff. And there'll be a link there where you'll be able to email him. And when you have questions for Daryl, there'll be a link there. But what we're going to do is we're going to put those Q&As on the website, on the page that it applies to. So you'll be able to come if at the end of 3 or 4 months, you want to go back and see what kind of questions people asked about stocks versus bonds, this might help you. Because what we are trying to do, again, help do-it-yourself investors do it better for a lifetime and help their children and help their grandchildren. That's the goal of our foundation. And I hope that we are successful for you. Thanks for watching.